Happy new tax year everybody, and welcome to the Rainey review for the March 2024 quarter. As befits a new year, returns for the March quarter were predominantly positive and in some cases outsized. This slide shows the growth of $1 invested 3 months ago in various asset classes. The leader for this time period in Navy is unhedged international shares, where $1 invested 3 months ago would have grown to $1.15. In second place, and with a slope very similar to that of the unhedged international shares, at least from the end of January, is emerging markets shares, where $1 invested 3 months ago would have grown to $1.08. Middle of the pack is that 50-50 mix of shares and property and cash and fixed interest, where $1 invested 3 months ago would have grown to $1.04. This slide shows the growth of $1 invested 12 months ago in those same asset classes. This time, the leader over 12 months is, once again, unhedged international shares in Navy, where $1 invested 12 months ago would have grown to $1.31. In second place, in Australian gold, is Australian shares, where $1 invested 12 months ago would have grown to $1.16. Middle of the pack is that 50-50 mix of shares and property and cash and fixed interest, where $1 invested 12 months ago would have grown to $1.10. That's an above average return for this mix of assets. I always say that 1 year is never long enough. We always need at least 3 years' data. This slide shows the same asset classes, this time if you'd invested 3 years ago rather than 3 months or 12 months. The leader is, again, unhedged international equities in Navy, where $1 invested 3 years ago would have grown to $1.50. Jostling for second place in orange is global infrastructure and Australian gold, Australian shares, where $1 invested 3 years ago would have grown to $1.32. After that, the slide begins to look a little bit ill. With the exception of cash and a 50-50 mix of shares and property and cash and fixed interest, all other asset classes delivered negative returns. The returns from those two asset classes were themselves pretty anemic. A 50-50 mix of shares and property and cash and fixed interest would have grown to $1.07. That's underwhelming. It's also quite similar to the $1.06 I spoke about in my last Rainey review. At that time, I indicated that I would test the premise that that return is both low and unusual. So that's what we're going to do today. My premise is that a 2% per annum return for a 50-50 portfolio is unusual. Here's the evidence. This chart shows the rolling 3-year returns for a 50-50 mix of shares and property and cash and fixed interest, international fixed interest and New Zealand equities from the period beginning January 1995 all the way to the end of March 2024. Because we are testing rolling 3-year time periods, the 351 months we have in total means 316 discrete time periods of 3 years. Over these 316 test periods, a 50-50 portfolio produced a return of less than 2% per annum on 14 occasions. That's a 1 in 22.6 likelihood, or 4.4% of the time. For contrast, international fixed interest produced a return of less than 2% per annum on 25 occasions. That's a 1 in 10.7 likelihood, or 9.4% of the time. New Zealand equities produced a return of less than 2% per annum on 73 occasions. That's a 1 in 4.3 likelihood, or 23.1% of the time. For that 50-50 portfolio, less than 5% of the time appears significant. While I haven't computed a p-test for statistical significance, it appears material at least at the intuition level. Now I could have stopped there, but I was having too much fun. So I've repeated the test, this time with a return of 0% per annum. That is, a negative return. This time, my premise is that less than 0% per annum returns, that is negative returns, over 3-year time periods is unusual. This is the same chart, this time searching for negative returns. Again, over these 316 test periods, a 50-50 portfolio produced a return of less than 0% per annum on one occasion. That's a 1 in 316 likelihood, or 0.3% of the time. International fixed interest produced a return of less than 0% per annum on 23 occasions. That's a 1 in 11.6 likelihood, or 8.6% of the time. New Zealand equities produced a return of less than 2% per annum on 49 occasions. That's a 1 in 6.4 likelihood, or 15.5% of the time. Again, I haven't computed a p-test for statistical significance, but 0.3% of the time is outside two standard deviations. That's a 95% confidence interval, which is a shortcut version of saying that the outcome is likely to be statistically significant. I could have stopped there as well, but I was still having too much fun. This time, I've run the original analysis, but now over a period of 5 years. That is, my premise is that a return of less than 2% per annum over 5 years is unusual. Over now 292 test periods, a 50-50 portfolio produced a return of less than 2% per annum never. That's 0% of the time. International fixed interest produced a return of less than 2% per annum on 24 occasions. That's a 1 in 10.1 likelihood, or 9.9% of the time. New Zealand equities produced a return of less than 2% per annum on 49 occasions. That's a 1 in 6 likelihood, or 16.8% of the time. Again, I haven't computed a p-test for statistical significance, but 0% is outside a 99.7% confidence interval. That's 3 standard deviations. That seems pretty significant. So, while low returns, even negative returns, do happen, they are rare. And actually, if you hold the portfolio for long enough, they disappear from the data altogether. So, to mangle a Rolling Stones classic, time is indeed on our side. Thank you for watching. I look forward to updating you again in the next edition of the Rainey Review.